Hey everybody, welcome to Our Stock Trades. In this channel, we love to help retail investors make strategic investments that will build long-term generational wealth. Yesterday, I made a video regarding SoFi and regarding to the share prospectus. Now we're going to take that share prospectus and we're going to set a price target. How is this share offering ultimately going to affect the stock price, which is what retail investors care about, okay? So now what we want to go ahead and see, and just to recap, if you haven't seen this video I posted yesterday, please stop it and watch it to go on to this one where we're going to set a price target. But first, just a quick recap. We went ahead and basically graphed the fundamentals of SoFi using literally a 1, 2, 3, 4 graph analysis. I want you to pay attention close to the free cash flow. It broke through our linear free cash flow trend line back in November, which basically sent a signal that you should get the hell out of the stock. Jamaat Palihapitiya went ahead and recognized this November 18, declared a sell, and told retail investors he sold 15% of his stake at around $21. I made a video a couple days after, 6 days after to be exact, November 24th, and unfortunately retail investors did not take heed of the warning. Yesterday I made the video and some retail investors still were resistant. It's almost like they like to be in the position they're in. And what they said is, you can't look at historic free cash flow. That's historic. That's the past. Well, it's a good indication of where the company's going, right? Likewise, they said that you need to go ahead and estimate what a DCF is. And they're trying to teach me what a DCF. Listen, guys, I've been doing this for about 10 years. This is our intrinsic value software, which is our proprietary model, which gives you the bull, base, and bear. We're going to go ahead and calculate that. But first, we're going to have to show you the assumptions we're going to be making because it's all about the assumptions, all right? So based off of this here, we're going to use the annual from 2018 to 2021, and we're going to look at the revenue. Unfortunately, the free cash flow for SoFi is in the negative trajectory, as indicated in the graph here. So you really can't use the actual free cash flow. So you're going to have to estimate it. So what I did is I gave them a generous 5% of revenue. Now, if you look at all of your favorite free cash flow positive companies, if you have any, if you take 5% and multiply it by the revenue, you're ultimately going to be getting a free cash flow of around 5% of the revenue. And if it's a SaaS company, it usually is around 15 to 20%. Now, what we're going to be doing now is we've estimated the free cash flow here, and then we got the average estimated free cash flow, which is 28 million. So we're going to go in and we're going to put 28 million in our model, okay? Then we're going to go ahead, and from this model, we're going to go out to be 10 years. So we're going to go from 2022 all the way up to 2032. Now, if we did 5 years, it would go out to 2027. We're going to go ahead and we're going to do 10 years, okay? Now, from this, we're going to have to then look at a growth rate. Now, based on this growth, from 2018 to 2019, SoFi grew around 64%. Now, from 2019 to 2020, 28%. 2020 to 2021, 74%. So we're going to go ahead and average these out, and we're going to give them 55%. Now, I personally like to take half of that to give me an excess margin of safety at around 28%. Now, but for retail, we're going to go ahead and give them the bullish case. We're going to expect them to grow 55% for the next 10 years, which is highly unlikely, but we're going to go ahead and do so. So we're going to go ahead and we're going to put 55%. Now, all we have to do now is look at the shares outstanding. So what we're going to do is we're going to go here to our proprietary software called Brain Machine. We're going to go ahead and hit SoFi, and it's going to go ahead and give us the shares outstanding, which is 799 million. And again, this is directly from the SEC filings that SoFi basically sends to the Security and Exchange Commission. So from this, we're going to go ahead and get that number, which is 799, around that, right? And you're going to get a stock price of anywhere between a bear case of $8 to a bull case of $17.39. Now, we do have a recession case, which is $3.42. Now, this is like I feel like we're in a quasi-recession right now. Usually the jobs market is not as, usually the jobs market is pretty weak when we have a particular recession here. But you can see the unemployment rate very quickly. It's at lows that we usually don't see. Now, this is technically a lagging indicator, so we're going to see if this starts upticking. But just to let you guys know, I don't think we're at a recession level case, but this is how low can it go based off of a 55% growth rate. Now, here's the thing, guys. Now let's talk about the share dilution. They want to do about 1 million. So we're going to go ahead and do 1 million. Again, that's 1,000 millions, right? Because there's 1,000 millions in a billion, okay? So then now we're going to go ahead and look at the stock price for SoFi. So we're going to go ahead and And we're going to see it's hovering at around $6.29. So we're going to put the stock price here. And again, we got these share prices without even putting the stock price because we got it from the books. So we're going to put it here, 6.2, was it 6.29? Let me just double check here. Yep, 6.29. So now we're going to put 6.29 here, and we're going to be taking the offering divided by the actual price, which gives you 158 million. Let's call it 159 million of shares. So now we have, for shares, we have 159 million. Now we're going to add it with our existing 799, and we're going to assume the worst. We're going to assume that they're going to dilute us now. They could dilute us at a higher share price, but we're just going to assume the worst. Okay? We're going to add the 159 with this, and that's 958. So we're going to put that there, 958. So based off of this, SoFi's stock price just dropped low. Now the bear case is $6.66. The base case is $9.52. And the bull case is $14.51. Now, if you look at it, that's exactly what it's trading at around. Now, you might be asking yourself, well, ladies and gentlemen, why? Was the market already anticipating a dilution for SoFi? Of course it was. Of course they were expecting a dilution. Just look at the fundamentals, right? There's obviously another method you could use. I personally don't do this because I like to take a higher discount rate, but you can use the treasury method. Just go ahead and Google it and learn what the treasury method is in determining outstanding shares. Which if you use the treasury method, you're going to get around 159 million, around that in terms of share dilution. So that's what is going to be happening with SoFi. But here's the problem, guys. Here's the problem. Now, this is 55%. I think I want to do, if I was going to get into the stock, I would do 28%. I would do a 28% growth rate. Now, if you do this, look at the stock price. Look how low it drops. You see? Now, if we were to double this and say, you know what, instead of the 5%, I want to go ahead and I want to give them 10%. I want to give them 10% of the actual estimated free cash flow. You're going to get 56 million. So if you did 56 million, then you can see a bull of around $4.87. Now, if you look at SoFi here, $4.82. So you can see it's all mathematically related. The market is starting to they're starting to price these things. So if I was retail, and this is just if I was in the stock at a very high bag, and if we did 55% and we give them the benefit of the doubt of 56 million, and once it does become free cash flow positive, which obviously they are not, we could see a potential stock price anywhere between $13 to $29. And based off of this, you could potentially 3x your money from the current share price if they grow 55% year over year for the next 10 years, and if they're able to get a free cash flow of around 10% of the revenue, which is approximately starting point of 56 million, which I think it's pretty attainable if they grow at these particular rates. Now, the thing is, they could, in 5 to 3 years, retail could take this up to $29, which I would automatically get the hell out. Now, if we were to go to SoFi and actually take a look, let's go here to our mastering course here and take a look at our technicals and fundamental analysis section. And let's take a look at SoFi here. And let's look at the all-time highs. It was trading at around... Let me double check. I want to make sure we get the highest. Yep, right around there. $28.29. $28.29, around $29. As of right now, that's the best we can get for SoFi, and that's with the share dilution. Now, if, let's say, they didn't do the share dilution, this is what we would have had, right? And again, it doesn't really change that much. It adds a couple bucks, right? But what we can do right now is we put the worst case scenario, 958. They have to grow at 55%. Personally, if they want to consider themselves a growth company, instead of 25, we'll give them 30%. But unfortunately, this is the stock price. So you can see how dangerous this is in regarding, why not invest in a company with a proven track record? PayPal is pretty undervalued. I mean, heck, I know with the Cayman Islands, Alibaba's looking pretty damn sexy, right? But, you don't really own the stock, but it's sure enough is a better business model than this, right? So I hope this made sense. This is evaluating it, but let me just kind of give you kind of the walk-away takeaway of this. I personally think this stock is going to grow maybe around 45%. And it's going to hover around anywhere between $10 to $15. I would get if I was going to take a position, I would get around $12. But the problem is that's only like, what is a 100% gain for so much risk? It's not worth it. And once, let's say we do end up in a recession, and we're going to find out, if you look at our economic calendar, we probably are going to end up in a recession in GDP Q2 of July 28. We're going to figure that one out. But overall, guys, it seems to me that it's a pretty risky stock. So I hope this analysis was great. If you want access to our proprietary software, we have been featured on Bloomberg, MarketWatch, NASDAQ, Benzinga, and Yahoo Finance because our product works. We give no BS education. And if you want to learn more, it's at allstocktrades.com. And it is always a privilege and honor to serve you and teach you and educate you. And I'll see you on the next one.